What does this week's VIX explosion say about the stock market? And is gold on the verge of a sell signal? I'll quantify it all on today's REKTelligence Report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the Thursday Edge Report where I quantify current market action across the most interesting assets of the week. So let's get right into it. Let's start with the stock market, and I'm recording this on Wednesday the 21st. Yesterday, we saw the volatility index, or VIX, absolutely rocket, and it closed over 25% in a single day. So what I want to find out is how has the stock market performed since we've had the VIX 10, 20, 30 days later after this has happened. I'll start with the S&P 500 index, or SPX, and to reiterate the single condition here, the very test is buy the market after the VIX has closed higher on any given day by 25% or more. And we see the history right here, 1990 to the present. This is when we've had the volatility index. Before then, we didn't. And you see the total P&L on the upper left-hand side is negative. That just means that this does not have an edge over that 10-day hold or that 10-day window. Now, are there instances here, and in fact, there are 54 total, have there been instances where the market is higher 10 days later? Yes, of course. You can see this equity curve, in fact, sloping up recently many times in the mid-teens, 2015 and on for a while. Yes, again. But overall, it has a net negative expectation. And we see that despite the profitability being 59 and change percent, that the market will be higher 10 days later, the expectation again is negative because the losses outweigh the gains in terms of magnitude. So the profit factor here is below 1. Just to reiterate what that means for the coming slides, profit factor measures the sum of gross gains divided by the sum of gross losses. So therefore, if a test or a strategy won $2 million and lost $2 million, let's just say, that is a result of 1.0, right? There's break even, no gain, no loss, there's no edge there. That would be a profit factor of 1. So that is the break even line. Above 1 is a positive profit factor. Below 1 is a negative profit factor. And again, you see here, there is no edge over 10 days. Let's go and run the same test with a 20-day hold time. Now you can see the total P&L is just barely positive. So this is just north of break even. If you look at the profit factor here is 1.063. It's technically a positive profit factor, but barely, right? It's just kind of noise. And we see that even over a 20-day window of time, after the VIX has rocketed to this extent in a single day, we really don't have an edge in the modern era and during the history of the VIX. If we go out with the S&P 500, 30 days now, so the volatility explosion happens, buy the market, 30 days later it's exited, we can see here, now there is a more meaningful edge a month later or 30 market days later, same thing. So we see that there are 47 instances. Profitability here now is 72.3% and change. Profit factor is respectable, 1.7 and change for the profit factor. So this is a fairly respectable edge. Let's look at what this is like on the NASDAQ now. 10-day hold. We're starting here again with the NASDAQ 100 index, same criteria, and hold it 10 days. This is actually slightly positive. Profit factor 1.19. So there's just a slight edge here for the NDX. What about 20-day hold time? We see 32.38 total return there for this query. Profit factor improves a little bit, 1.33. I'd like to see a profit factor of 1.5 or higher typically. So we don't quite have that here. Profitability though, again, is 61 and change percent. So that kind of holds across both S&P and NASDAQ. But let's go to that 30-day window with the NDX now, and we can see total P&L is sharply higher. Profit factor is north of 2, and the hit rate or profitable trades, as you see on screen, is 70.21%. That is all quite excellent across the board. I'm really not concentrating on drawdown because this is more of a query as opposed to a portfolio strategy or anything like that. I really just want to know the tendency or trend of the market historically. And NDX seems to offer the best opportunity following a VIX explosion like this with a 30-day hold time. Let's talk crypto. We just saw Bitcoin lose 4.5% or more in a single day while also closing at a 15-day low. Now, technically, it just recently closed at a 19-day low, but I usually test in the 5 increments like 15, 20, 25, 30, and so forth. So that's what I'll do here. Now, you can see on this chart several days down for Bitcoin. That's a condition I could have added. I would have gotten fewer results. But nevertheless, several days down, we see it closed at a 15-day low or greater, and it closed down at least 4.5%. So let's look at the stats with various hold times. We'll start with the 10-day hold after these conditions have met. So in other words, buy Bitcoin, hold for 10 days once these conditions are in place. And there is a slight edge. This is 2011 to the present, so really the reliable start date for data for Bitcoin is 2011 all the way again to the present. Now you see 22.86% over all that time. Is that any great shakes? No, it's not. It is obviously a slight positive expectation. Profit factor is just barely north of 1.071. So again, technically on the right side of that one figure, but not by much. And profitability here is 54% of the time, 10 days later is going to be positive with, again, just kind of a minuscule edge here. Now, if we go out to a 20-day hold time, this definitely improves. We see total P&L 327 and change percent over all of these 44 instances. Profitable trades is around the same figure, 52.2%. Profit factor now a little bit more respectable, not amazing, but 1.293. 1.5 or greater would be better, but obviously we have a positive profit factor above 1. And this is, a respectable result. So again, over 20 days, historically speaking, I would expect this to be positive, Bitcoin to be positive. Now, 30-day hold time, let's take a look at this. We once again have a pretty good number in terms of total P&L, 242.08%, all in. 49 instances. Profitability has fallen, which is interesting. A month later, only 40.82% of the time is it higher 30 days out. Profit factor has taken a little hit from 20 days to 30 days, now only 1.187. So the edge seems to diminish over that 30-day window. 20-day seems to be the sweet spot, at least in terms of what I've looked at here today. So I'll be keeping an eye on this. And of course, I'll probably touch on Bitcoin and probably some alts as well in my Monday All Markets report. Okay, my commodity edge for today is once again going to be gold, and I believe you'll agree for good reason. So before I get into this daily chart and this new insight and the test I'm about to run, let's talk just briefly about what I covered in a recent video and in a note or two as well, which was gold on a monthly chart, a long period of history back to the 70s, the January 1980 peak, and we talked about it in that context with the same indicator, but in a totally different context. Now, I want to look right here at this gold futures chart, and you can see there's a 20-day moving average here, and gold on the right-hand side has been climbing as I record this for the last couple sessions, moving up and away from its rising 20 MA. Below, you see the stretch percent indicator, and there is a dashed green line. The green line represents a 7% stretch level above the 20 MA. So when gold gets that amount or greater higher, it's going to be at or above that green dotted line. And let's see how gold performs once it's at that level. So I've got it all in one window this time, and I've got average trade here on this chart with a 10-day hold, a 20-day hold, and a 30-day hold once gold has closed at least 7% or higher above its 20 MA. And the nutshell bottom line here is that there's a negative expectation. The average trade is negative across the board here, negative 1.55% with a 10-day hold, negative 0.76% with a 20-day hold, negative 2.36% with a 30-day hold. And this is, again, across the board, a negative expectation when we see the daily stretch reach that 7% or higher level. Now, does this mean right now in today's market, we're gold to close with a 7% or higher stretch level that 10, 20, 30 days out is going to be negative? No, it doesn't. It could be the exception, but the norm historically has been a negative average return. And if you look at some of the other stats, I'll just quickly point out win percent, very low, 33, 40, and 20%. Profit factor is well below 1. So it's been a pretty resoundingly negative expectation based on this stretch percent criteria. Okay, time to look at the credit market. And once again, I'm going to look at the high yield ETF LQD. We see it here on a daily chart with a moving average, which is the 200 simple moving average. And it's above it, and it recently closed at least a 90-day low. And those are the conditions I wanted to look at. Very simple, 90-day or greater closing low, but above its 200 MA. Let's see what the stats look like. With a 10-day hold after these conditions have set up, there have only been 5 instances, so very little data to look at, and there's a slight negative edge here for LQD. Now, profit factor is very low, 0.387. That is well below 1, so it's kind of been a resoundingly negative edge over this window of time. There's just not a ton of data, obviously, with 5 instances. Let's look at 20 days, and we see with a 20-day hold, now we're just barely a tick north of break-even total P&L for these 5 instances over all of this time, which is, by the way, 2003 to the present, 0.30% total return. So profit factor is basically at 1.07, just north of it. There have been 60% profitable trades, so 3 of 5, but not a lot of data to look at. 30-day hold, we see we're back to a negative expectation. So basically, my takeaway with this limited data in LQD is not to expect much from high yield, based at least on LQD, going forward over the next month and throughout that month. So I had to share this picture that I recently took of 2 adolescent donkeys in the middle of the road. And don't worry, they did get out of the road, but this is quite common where I live. Heading back to the house, these siblings most likely, just for an afternoon stroll. And this is the kind of thing I get to see when I'm away from my screens, which I really love. Folks, thank you for watching this video. I hope you got something or some things to take away from this. And look for my next report, which will be out Monday, the All Markets Report. Until then, have a great day, trade well, and I will see you soon.